Did you know there is a remarkable trader out there who surpasses even Warren Buffett? This trader compounded money at a 3x rate compared to Warren Buffett. His fund Medallion has delivered an average gross return of 66% since 1988 compared to Buffett's only 20%. I call him trader rather than investor because the average holding period of his trades is only 2 days. Buffett began investing at the age of 10 and is now 92, compounding for 82 years. Also, you should know 95% of his wealth came after the age of 65. Can you guess how much money this trader will make if he gets 82 years to compound at the same rate? It's 65 quintillion. Probably you don't know what is quintillion. 1 quintillion consists of these many zeros. Or 1 quintillion is equal to millions. Or 1 quintillion is billions. He is none other than Jim Harris Simons, an unsung trading hero, mathematician and a philanthropist. He used only mathematical inbuilt swing trading strategies to make all this wealth. Is it possible to make that much of money in swing trading? So in this video, let's study in-depth aspects of swing trading. Before we learn how to take trades in swing trading, let's understand what really swing trading is, because many traders get confused swing trading with other trading types. So I will explain different trading types quickly and then I will proceed with the explanation of swing trading. So there are three important trading types. So one is intraday trading, another one is positional trading. Okay, in intraday trading, there is no overnight position. Whatever the trades we take, we will close on the same day. Whereas in positional trading, the holding period exceeds 1 month, which means we will take trade today and the holding period will be minimum 1 month. So I might hold more than 1 month or 2 months or 3 months, something like that. Intraday traders aim to make 1% daily, whereas positional traders aim to make more than 10% on an average. In intraday trading, people take more quantity because there is no overnight risk, right? So in positional trading, there is an overnight risk because price can show gap up or gap down open against your position and hence they will deploy less quantity. Now, swing trading really fits in between intraday trading as well as positional trading, okay? Because holding period varies between 1 day to 1 month. Okay, in intraday trading it is only 1 day, in positional trading it is greater than 1 month. So whereas in swing trading the holding period is in between 1 day and 1 month. And swing traders somewhere aims to make on an average 1 to 10% for their trades and less quantity as well. So the difference between swing trading and positional trading, main difference is positional traders look for more diversification because their holding period is greater than 1 month, right? A simple war or a simple earthquake can change the scenario entirely. So that's where in positional traders, they look for more diversification, but they maintain less quantity. Whereas in swing trading, there is no need to look for more diversification because the holding period is less than 1 month. Also, you shouldn't have the below qualities to become a swing trader. Not following stop loss rule. If you have an habit of not following a stop loss, or if you have an habit of not placing stop loss in your system, or if you have an habit of changing your stop loss again and again, then this quality doesn't suit to make money in swing trading. And number 2 is closing winning trades early and carrying losing trades. So you should know how to write the profitable trades and how to close the losing trades early. And number 3 is depending upon news. If you have a dependency on news to pick stocks, then you will go wrong. Because always price moves come first and the information will be broadcasted in news later. And number 4, having no patience and practice to learn the trading. Friends, as I said earlier, any trades between 0 to 1 day falls under intraday trading category, and any trades above 1 month holding period falls under positional trading category, and any trades between 1 day to 1 month falls under swing trading category, right? Now, we can use any technical concept from technical analysis to pick the trades which falls under swing trading category. So it can be price action based, or it can be moving average based, or it can be Ikinashi based, or you can use any other trading concept which falls under swing trading, right? But following one strategy or two strategy is more important. What happens is many beginners, they try to study multiple strategies at a time, and they will not be able to get the in-depth knowledge in any strategy actually. So they will be studying different strategies, and they will get little knowledge about all the strategies, and they don't get the in-depth information, and they will not be able to give justice to that particular strategy also. And when you are taking trades in the live market, they will not get that conviction or confidence to take the trade. So as part of this explanation, I will be focusing only on two things. One is RSI based, that is indicator based. Another one is a price action. So I'll be explaining swing trading strategy and RSI using an RSI indicator, and also I will explain a swing trading strategy based on price action. So if you are really oriented or interested towards using an indicator, you can pick RSI based strategy. If you are really interested for price action, you can pick price action strategy. See friends, using an indicator is not really bad, okay? At the end of the day, making money is important. Whether you use an indicator or you use an price action, that doesn't matter. Making money is very, very important. Many traders blame or condemn indicator traders in a wrong manner. That's not really necessary, because indicators bring discipline in our trading, right? They will come up with some rules for taking trades or exiting trades, and hence they bring the discipline in our trading, and also it helps us to avoid revenge trading, right? So otherwise we will end up taking many number of trades. So indicators are always good for beginners and even intermediate level traders, okay? Even I've seen many people who are experts who use indicators for different aspects of the trading. So now we'll focus on RSI based strategy. Again, in RSI based, there are two important concepts. One is 70-30 rule, overbought, oversold situation. I don't suggest this to use this, because whenever the price is in a strong uptrend, RSI can stay above 70, which is an overbought situation, for a long duration. If you take a short trade at that point of time, you always end up making losses in a strong uptrend. Similarly, when the RSI is below 30 in a strong downtrend, RSI can stay below 30 for a longer duration. If you take a long trade at that point of time, in a strong downtrend, you always end up making losses. So instead of this, I suggest 40-60 rule. I have made a separate video for this, because anything above 60 is bullish, below 40 is bearish, 40 to 60 is sideways. So I have made a separate video on this topic, detailed video on this topic. If you want to know more about that topic, you can watch that video. I will share the link in the description, okay? And another thing is divergence. So right now we will focus on divergence. Again, I don't use the divergence theory as it is. I will be using it in a different manner. So now again, in divergence, there are two types of divergence traditionally: bullish divergence and bearish divergence. So I'm explaining once again, I don't use this divergences as it is, but before I explain how I use the divergences, it is better to understand the traditional version of bullish and bearish divergence. Then you will understand my version very, very easily. So now we will take a bearish divergence for an example. Okay, so this is a chart. So according to bearish divergence, price makes higher high and RSI makes lower high. Okay, I'll repeat once again. According to the bearish divergence theory, price makes higher high, RSI makes lower high. So this is recognized as bearish divergence according to the traditional definition, and they suggest, or this theory suggests to take a short trade whenever you see this divergence. Okay, so this is bearish divergence. Now bullish divergence is, this is a price makes lower low, whereas RSI makes higher low. So this is bullish divergence according to traditional theory, and traditional theory suggests to take a long trade whenever you spot a bullish divergence. I hope traditional definition of bearish divergence and bullish divergence is clear. Now, my point is, or my explanation is, either bullish divergence or bearish divergence doesn't work well. The simple reason is they always suggest us to take the trade against the direction of the trend, isn't it? Whenever there is a bearish divergence, it comes in uptrend, it suggests us to take the trade against the direction of the trend. Whenever you see a bullish divergence, it comes in a downtrend, it suggests us to take the trade, long trade, in the against the direction of the trend, right? This is where I don't understand the traditional concept, because in one hand they say don't take the trade against the direction of the trend, and the other hand the traditional definition says to take the trade against the direction of the trend. So this is where retail traders get a lot of confusion, and they end up or they mess up taking different kind of trades, or more number of trades with different risk, or they face more failures actually. Okay, see, if you don't believe my words, you can look in the charts. I will share some of the charts. For example, this is RO Pharma daily chart. Okay, whatever I'm going to explain as part of in this strategy, you can use it in daily chart. Again, it can also be applied in 4-hour or 2-hour chart, but it works well in daily chart, because for swing trading, our holding period varies between 1 day to 1 month, right? Now, this is RO Pharma chart. Just look at this. Price made higher high. Do you agree? And RSI made lower high. Agree. Lower high. So this is bearish divergence according to the RSI traditional definition, right? So what it says is take short trade at this point of time. But look at the prior trend. It is uptrend, right? It is a prior trend, and look what happened after that also. Okay, the trend continued, right? So it is not a good idea. So you can look at the same chart once again. One more time it came. See here again, price made higher high, right? Whereas RSI made lower high. Once again, this is a bearish divergence according to the traditional definition. Once again, please note friends, this is suggesting us to take the trade against the direction of the strong trend. It is not a good idea. Always don't take trades against the direction of the strong trend. So that's called as contra trading. I mean contra trends, and there are many variation, contra trading, etc. Only experts can do that. This is not for beginners, even for intermediate level traders. Again, you can see what happened here after this. The rally continued, right? The trend continued. Okay, so this is where the problem starts actually. You can see one more, I think two more, price made higher highs. Again, RSI kept on making lower highs. You can see what happened, right? It always suggests us to take the trade against the direction of the trend. Okay, we'll see one more chart. So this is the failure of the bullish divergence. For example, ACC Limited. This is ACC Limited chart, and price is in a strong downtrend, right? So here price made lower high, whereas RSI made price made lower low, whereas RSI made higher low, but the trend continued, right? So this is a bearish this is bullish divergence according to the RS theory, but it failed actually. Okay, it occurred one more time. So price made lower low, whereas RSI made higher low, and the rally continued. So it is always suggesting us to take the trade against the direction of the trend. Okay, so now as I said earlier, if there is a strong uptrend, price always makes higher high, and RSI makes lower high, and it goes on like this. So it always suggests us to take the trades against the direction of the trend. So it is not at all a good idea. Okay friends, so now then what should be used? So according to this theory, again I read it in John Hayden's book, RSI hidden divergence is the best thing. So this is bullish divergence. I'll be explaining bullish divergence. So for example, this make higher low. Okay, these are the swing lows. This made the price made higher low, whereas RSI made a lower low. So this is called as RSI hidden divergence, bullish divergence. So this is best to use actually. Okay, so because this helps us to take the trade in the direction of the trend. So according to the hidden divergence, hidden bullish divergence, I will be focusing more on hidden divergence, especially bullish hidden divergence, because I will be explaining this strategy as part of swing trading. And in swing trading, many retail traders, they take trades only in equity. They will not be, or they don't have the capacity or capital size to take trades in futures actually. So that is the reason I'll be focusing more on hidden bullish divergence. It helps us to take the trades in the uptrend, which means long trades. Okay, so again I will explain in a simple manner. Hidden bullish divergence is very simple. Price makes higher low, whereas RSI makes lower low, right? Price makes higher low, RSI makes lower low. So this is hidden bullish divergence. So now this is an example. Nifty, it made an higher low, right? So the trend was uptrend from the beginning. It made an higher low, whereas RSI made lower low. You can see what happened after that. It's very simple. We can check one more example. This is Bank Nifty. Again, price made higher low, whereas RSI made lower low, and the original trend was up. And now it is suggesting us to take the long trade, which is in the direction of the trend. And you can see what happened after that, right? So now one more example, BPCL. See, now I will be going a little in depth, okay? So sometimes what happens is the trend is already established, which is very, very strong from the beginning. So we can also take the trade, but I also give a simple idea to write the trend from the beginning actually. See, now if you look at this resistance trend line, the price is in a small sideways to downside, right? The breakout indicates the trend has changed, which means now the small downtrend or sideways trend is over, the breakout is over. Now what we should do is, after the breakout, we should look for the first hidden bullish divergence. If you can able to spot it, and if you can take the trade, there is a high possibility of catching the trend till the end actually. See, this breakout is happened. Now see here, the price made higher low, right? The price made higher low. If you look at the RSI, it made a lower low. This is a classical hidden bullish divergence. If you can take the trade, right, you will be riding the profits actually from the beginning. So now, as I said earlier, I will be focusing more on bullish hidden divergence, but you can also look at RSI hidden bearish divergence. So this is helpful for F1 traders, because in India at this point of time we can't carry short trades in equity for more than 1 day. So it is helpful only for F1 traders. If you are a retail trader, you don't have to worry about this, but conceptually you can know this. So it is also very simple. Hidden bearish divergence is price makes a lower high, whereas RSI makes a higher high. This is a classical hidden bearish divergence, and it suggests us to take the trade in the direction of the trend, because prior trend was also down, and it is also suggesting us to take the trade in the direction of the trend. So this is classical hidden bearish divergence. So again, as I said earlier, if you are a F1 trader, you can explore yourself with charts. Don't believe whatever I'm going to say as it is. You can explore each and concept on the charts, and then only you can trust it. Now we will look at some charts so that you will get the concepts in a very, very good manner. So what we can do is, we can go to trading view, we can plot the RSI indicator. Again, RSI in trading view comes with a hell lot of futures, so you don't get confused. I will show the settings so that it looks very easy according to you. So right now, disable everything. I will be explaining RSI based MA at the end to smoothen the curve, but right now I will be removing everything. So go to trading view, apply RSI and remove everything. Okay, don't use anything, you remove everything, because simplicity is always best. When we use too many things in life, it always gets complicated. Again, in RSI, go to this increase this thing, so that it appears very clearly. Okay, so now okay, we are in Nifty, right? Again, you can see, I will open this. So I'm in Nifty. What I will be doing is, for example, anyway we have plotted this. Now if I go here, for example, this is a breakout, right? From here the breakout happened, right? Or at least from here the breakout happened, right? So now you should look for a RSI hidden bullish divergence to plan for a long trade. Okay, so now see here, from I will remove this. See here, from here to here. Okay, so here to here, higher low, right? Here to here, this is lower low, right? This is a classical hidden bullish divergence, and you can see what happened after that. Price went upside. Okay, so this is with Nifty. So I will go to some other charts. For example, I will go to Reliance. Okay, so in Reliance also, see friends, this is very clear. The price, this is a strong, this is not a strong, I mean mild sideways to downside trend. Price breakout, right? This is a clear cut of breakout. So this is breakout happened. So from here it is uptrend started. So now here you can see here it made an higher low, but this is also a higher low. So again, this is not a classical hidden divergence. So you should look further. Okay, see here, this is higher low, right? Price made higher low. This is RSI made a lower low, right? This is classical hidden bullish divergence. You can see what happened after that. Okay, this is a daily chart. So you will be holding trades for a few days, 1 day to 1 month. You can use any trailing SL concept, like you can trial your stop losses below the low of every swing, or you can use ATR indicator, you can use super trend indicator, you can use any indicator to trial your stop losses. That's a one thing. So now what we can do is, I will delete this. We can go to some more charts like BPCL. If you go to BPCL, again, see friends, this is a sideways trend. I will write like this. From here the uptrend started, right? Can you see here to here, it made an higher low, right? Higher low. And if you see here, RSI made a lower low, right? So this is a classical hidden bullish divergence, and you can see what happened after that, right? Okay, the price went upside, right? And again, I will delete this. I will go to some other chart like you can check Adani also. The price action is not really smooth in these days, but we can check. Okay, so you can see here, friends, this is where the breakout happened. This is a breakout candle, breakout happened. So what I suggest is, look for a hidden bullish divergence after the breakout. See here the price made higher low, whereas RSI made lower low, right? This is a hidden bullish divergence. From here price went upside, right? I will explain. I will take one more chart. For example, we can check RO Pharma. So in RO Pharma, the price is already in a strong uptrend. So what I suggest is, if you can able to catch the trend from the beginning, then it's really good. Again, we also get trading opportunities and after that. But if you can ride the trend from the beginning, it is really, really good. So if you zoom in RSI, okay, so from here the breakout happened, from here the uptrend started. Look for a hidden bullish divergence in this case. Okay, so it's not here, it's here. See friends, see for example, from here to here the price made higher low, right? But check here, RSI made a lower low. This is again a classical hidden bullish divergence, and trend is also strong upside from the beginning. It suggests us to take a long trade here. So it is in the direction of the trend. You can see what happened after that. Okay, So this is one thing. And now you can ask me how to take the trade at that point of time. See, what happens is whenever you spot a hidden bullish divergence, don't take the trade immediately. For example, at this point of time also, this is a classical hidden divergence, not exactly, maybe, okay, it's really close, right? But don't take the trade immediately. Wait for a strong reversal or confirmation signal from the price. Okay, this is similar to bullish engulfing, right? If not bullish engulfing, you can see this, if not bullish engulfing, so this one candle engulfs the average or the range of last 10 to 12 trading days, right? So this indicates strong bullish behavior of the price. So whenever you spot a RSI hidden bullish divergence, don't take the trade immediately. Wait for some sort of price confirmation. It can be bullish engulfing, it can be bullish harami, it can be a bullish pin bar. Bullish pin bar look like this, friends, like an hammer. It looks like this. Small wick is okay. So it can be like this, or it can be bullish harami, or a rejection concept, price rejection and price acceptance. So price rejection concept is also very important, friends. If you want to know more about price rejection, I have made a separate detailed video on price action, again price acceptance and price rejection. You can watch that video. I will also share that link in the description, friends. So now we will go back to some more examples and then we can study. For example, if we go to again Nifty, we'll check. See, friends, strong reversal signal is this. For example, here to here it made in higher higher low, right? From here to here it is again lower low. See, it had made a higher low here also. It had made a lower low here also, but we don't take the trade here because this is a doji candle, right? So this is not a strong reversal. This is not even a price rejection. This is a doji. So we don't take the trade until we see a strong reversal. This look like a some sort of strong reversal because it closed above 50% of the above the 50% of the bearish candle. Okay, so this is one decent thing. And now if you look at some other charts also, for example, we'll go to TCS. So TCS is important thing. Again in TCS the price action is not really smooth. Again, if you spot this, we can say here the breakout happened. Actually it breakout displayed with a good breakout candle. Price came back and it is taking support at the breakout point, right? So this is a pullback trading. And if you look at RSI, I mean the price is made higher low, right? RSI made lower low. Can you see this? Okay, again this is a classical hidden bullish divergence. And if you look at this, I'll remove everything. If you look at this, see this candle, this is a strong bullish candle, right? So you can take a long trade above the high of this candle, keeping a stop loss below the low of that candle or below the low of the swing. Okay, so this should be your entry point and this should be your stop loss. And as I said earlier, you can trial your stop loss below the low of every swing, or you can use ATR indicator, or you can use any moving average indicator to trial your stop losses. So we will revisit all the stocks which I'm discussed now. Or instead of revisiting, I noticed a different concept now. So this is a website which picks stocks randomly. Okay, I don't have any control in it. So we will pick some random stocks and we will check whether the concept holds good or not. Okay, so this is ABS LAMC. I haven't heard about this company. ABS LAMC Aditya Birla. Okay. See, here also the price action is not really smooth, but from here the breakout happened. At least I say, this is the important price level. From here it is a strong, not strong, but from here it is uptrend started, but at least this is an important level. Okay, now I will remove this. I'll remove everything. Okay, see here, this is a higher low, right? This is a lower low. Can you see? And there is a kind of bullish engulfing here. If it were taken a long trade, it went upside, and after that we didn't get any hidden bullish divergence, right? So we will check some other stock. For example, I will remove this. I will go to here, random once again. Genesis, we'll go to Genesis, GENESYS, Genesis International. Again, price action is not really smooth. In this case, again, it is in a strong downtrend. This indicates downtrend is over, and here the first swing low after the breakout, but it didn't made an lower low in RSI, right? It is same higher low. So this is not a hidden divergence. If you go further, again it made higher low, higher low. See now, here to here. So here to this candle, this particular swing low, it made a RSI hidden divergence. So it is giving a trade here, okay, above the bullish candle high, and this is our stop loss. This is entry or this is our stop loss. So we'll check some other stocks as well. I'll pick one more thing. For example, this is SYI, SYL, Sierra Silk, SYI, SIL, SY. SYIY, SIYSIL. This is Sierra Silk. Price action is not at all smooth. It is in a complete sideways trend. It is RSI is also in between 40-60. It's not a good thing. I mean, we don't have any trade in it. I'll pick one more random stock. This is Happiest Minds Technology, HAPPS, happiest TMN. Okay, it's not showing the stock. It's okay. We'll pick some other stock. MMFL. We can check this. We can check MMFL. Again, price action is not really smooth. It is in a complete sideways trend. Again, if you see here, still there is a hidden bullish divergence. See here to here, and here to here, but this is okay. We'll pick some other stock. Mohit India, MOHIT, Mohit Industries. So if you go to Mohit Industries, again price action is not at all really smooth. We'll pick some other stock. Friends, if you use any indicator or if you use any price action, if the price action is not really smooth on charts, you don't get good trades, because most of the times a higher number of probability it takes the stop loss and goes upside, or it triggers your entry point and come back. Okay, because of those reasons, I don't suggest taking trades in the stocks when the price action is not really smooth. Jayashree Tea Industries, Jayashree Tea. Again, price action is not really smooth. This indicates the breakout. Okay, I mean there is a simple trade here, but that's okay. It's not really very smooth. Thomas Cook India Limited. We can check this. THO. Thomas Cook is okay. We can see. I hope the price action is smooth in this case. Okay. See friends, from here to here. Okay, I will write this, or I will add a line about this, or I will add a trend line about this. See, from here to here, do you agree this is a resistance line? It's very clear, right? Do you agree this is a breakout point? I will zoom out. Do you agree this is a breakout point? Breakout happened very clearly, right? So now after the breakout, look for first RSI hidden bullish divergence. See, price made higher low, RSI also made higher low. This is not a hidden divergence, so we don't take the trade. So from here you can say this is one more swing low, this is one more swing low. from here to here it made higher low, whereas from here to here it made lower low, right? This is hidden divergence. You can take a trade here, or you can also take a trade here. If you compare it to this is a classical thing. This is a higher low, again here lower low. This is a classical daily divergence. You got the bullish confirmation also. It is a big buying candle, so you can take a long trade above this. This is a long trade entry, and the stop loss should be below this, and you can see what happened after that in the price. Correct, right? It went upside actually. Okay, you can trial your stop losses below the low of every swing candle. So this is how we can take the swing trading using RSI divergence, friends. Similar concepts works in RSI hidden bearish divergence as well. Before I explain swing trading strategy using price action, I want to explain one simple concept, friends. People knew this, but we will not be able to think about it consciously, or we will not recall this concept consciously when trading or even investing. Okay, so this graph plots about reduction in capital versus gain percentage required to break even. Let's say you lost 10% of your capital. You starts with 1 lakh rupees or 10 lakh rupees. You lost 1 lakh rupees. Do you know how much percentage gain required from 9 lakh to reach the break-even level? It is 11.1%, friends. Now, again, let's say you lost 20% of your capital, which means from 10 lakh, it came down to 8 lakh. Do you know how much percentage gain required to break even? It is 25%, friends. Previously, it is 11.1. When you lose 20%, you need to make 25% of the percentage gain from 8 lakh capital to reach the break-even level. Not about the profit, friends, to reach the break-even level. Now, do you know how much capital you required? Suppose how much percentage gain required if you lose 30% of the capital? It is 42.9%, friends. One more thing, if you lose 40% of the capital, which means out of 10 lakh, if your capital reduces to 6 lakh, do you know how much percentage gain required on 6 lakh to reach 10 lakh? It is 66.7%, friend. 66.7, it's almost 67, friends. So on 6 lakh, you need to make 67% returns to reach the original capital. So last example, what happens if you lose 50% of your capital? You need to make 100% of the capital on original, the delayed capital. For example, if you are from 10 lakh, it came down to 5 lakh, means you need to make another 5 lakh, 100% to reach your original capital, friends. So this is where capital prevention is very, very important. So most beginners don't think about preventing or protecting their capital. So they always take more number of trades in a day, or they always take revenge trades, or they always take more risk per trade. So market will not go anywhere, friends. Market will be there forever. So you should pick a one particular trading strategy. I would say you study on not 100, if not 100, you study on 500. You should study on 1000 charts. But once you get the confidence and conviction, you should risk only maximum 2 to 3% of your capital on the trade, on any trade, and then you should take the trade, friends. If you continue like this, protecting your capital as much as possible, definitely you will fall in the winning category and you start to make good profits in trading, even in this case swing trading. My next strategy is on price action. So before I explain my strategy, I want to explain a simple example. Okay, whenever in India, whenever the petrol or diesel prices crosses above 100 rupees, there will be lot of strikes or media. There are many news, right? Every newspaper talks about it, and every TV channels make a debate about it, and they do all kind of dramas, right? And whenever the price comes back below 100, even if it is 97 or 98 rupees, all the dramas will disappear, right? Do you know why this happens? Any reason? Think about it. Now I will take one more example, okay? Whenever you visit a mall, you go to any mall and observe any products. They are priced at 99, 199, 499, 999, right? So what will happen in just 1 rupee, for example, instead of 999, they would have kept 2000 rupees, right? In 1 rupee, it doesn't matter, right? But still they keep at 999 only. Do you know what is the reason? Okay, it is smart thinking, because whenever unconsciously we have some resistance stored at round numbers. For example, if it is less than 100, it is a good thing. If it is 1000, there is a resistance. So for every round numbers, we store a resistance actually. If you are getting 1 lakh salary, it is a very good salary. If you get 97, 98,000 rupees, you don't feel good. So because of all those reasons, if they keep 1,000 rupees for a particular product, whatever the sales they get, if they keep at 999, they will get 3 to 4 times of the sales. So that is the marketing strategy they use. That is why they keep the products at 99, 199 or 499 or 999 like that. Now, similarly, some numbers plays a crucial role in trading as well, along with these round numbers. Because if you take any stock, XYZ stock, there will be several set of people, a group of people, they trade that particular instrument again and again, right? So along with these round numbers, there are some numbers, they play very crucial role with every instrument, whether it is a stock or index or commodity, they play a very important role. For example, you take this stock. This is ACC Limited chart, a daily chart. So if you observe very carefully here, whenever the price came to 2460 to 2480 level, it acted as a strong support, right? Whenever the price came to this level, buyers usually they will come in and they will buy in huge quantity, and their power only pushes the price on the upside, right? This is called as support actually. Okay. And this is one more example. This is TCS daily chart. Whenever the price came to 4050 to 4080 level, buyers, they pitched in with a big quantity, and their buying efforts pushed the price on the upside, isn't it? Similarly, if you observe this chart very carefully here, whenever the price came to 410 to 420 level, sellers pitched in, right? Sellers came and their effort pushes the price on the downside, isn't it? This is called as resistance. Okay, if they are supporting from the bottom side, means it is support. If they are resisting from the top, means it is resistance. Okay, so this is one more example, ICICI Bank daily chart. Whenever the price bounces to 950 to 960 level, these sellers pitched in and they think it is a very high value for 950 to 960 in ICICI Bank, and their effort pushes the price on the downside, isn't it? Now you should note one more thing. This support and resistance concept also comes in a small angle, because if you observe any commodity price like milk or rice, the prices of these commodities, they increased very gradually, right? So last year, as compared to if you take 1 liter milk or half liter milk compared to the last year, it raised by 2 to 5 rupees, right? So in this way, gradual increase is okay. So small angle for this trend line for both support and resistance is fine, but to ensure it will not have a very steep line like more than 45 degree. That indicates an unhealthy sign of a trend. So small angle is fine. See, you should try to connect the peaks like this. So then it will become a valid support or resistance line. In this case, this is a valid resistance line in Reliance Industries. Now this is one more example for a angled support trend line. This is with SDFC. So the small angle is acceptable. Now the strategy. Okay, the strategy is very simple. We need to pick the stock or any stocks which has a smooth price action, because if you pick a stock which don't have a smooth price action, means there is a high possibility of taking your stop loss, or it will trigger your entry price unnecessarily and it will go on the downside. So always pick the stocks which has smooth price action, and you should identify the support and resistance level. That is very, very important. You should clearly draw the support and resistance level lines. So if it is not there, then you can move on to another stock. There is no need to trade in that particular stock itself, right? Then you need to wait until the price comes to the support level. Okay, but when the price comes to the support level, don't take the long trade immediately, because you never know, there is also a small possibility of price breaking the support, and it might go further down as well. So whenever the price comes to support level, don't buy immediately, and you should look for a reversal signal. When I say reversal, it can be through a candlestick formation like bullish engulfing or a big hammer, or through price rejection. Okay, with these things, you need to wait for a proper reversal signal. You need to take a long trade only above the high of the reversal candle. Okay, and when you take a long trade, you just ensure you should not risk more than 2% of your capital. So if you have 1 lakh rupees, even if the price comes back and takes your stop loss, you should not lose more than 2000 rupees in this particular trade. So you should not risk more than 2%, and your entry should come above the high of the reversal candle, and you should place a stop loss below the low of the reversal candle. That is very, very important. A stop loss is must. If you don't keep an habit of not placing the stop loss, definitely you will lose all your capital in very few days or few weeks or few months. Now, after taking the trade, one can use a technique to trial the stop loss. You can use either moving average, ATR, or any next to the swing low. You can use any strategy to deploy to trial the stop loss. So when the price comes to the resistance level, you can exit your trade. That is one strategy. So very few traders, they want to ride the further trends as well. So such kind of traders, they can exit the 50 to 75% of their position at the resistance level, and they can carry the remaining 25% position. Okay, so I will talk about few examples. For example, this is ICICI Bank daily chart, right? So now, do you see this is a proper support trend line? Clear, right? We have connected the peaks, and this is a proper resistance trend line, right? It is going in a particular channel. That's very important. And observe carefully. So there is a strong reversal candle, right? Price came near the support, and there is a strong reversal signal, bullish candle. So our entry should come above the high of the candle, bullish candle, and our stop loss should be below the low of the that reversal candle, or one candle below, because that defines a proper swing low. So you can place a stop loss below that low, and your target will be this channel high. This is the target, right? So if you observe here, it has met the target, and it may be around 1:4 or 1:5 risk reward trade, and it is a holding period. Within a month, approximately in a month, it moved to that target, right? Because in swing trading, holding period should be greater than 1 day, and it should be less than 1 month, right? So approximately in a month, it reached the target, right? We'll talk about one more example. This is TCS daily chart. So this is a proper support trend line, right? And this is a resistance trend line. So if you observe very carefully here, there is a big hammer actually, and next one is bullish army. So you can take the trade above the high of the hammer, or you can take the trade above the high of the bullish army, and stop loss should be below the low of that particular swing. Okay, then the target will be resistance line. So if you are if you want to ride the profits, means 50 to 75% of the position, you can exit your position at the target. Remaining position you can always carry. So this is one more example. This is a Tata Steel Limited chart. Again, the original trend is really upside, right? In a bigger way, it is upside. And if you observe, this is a proper support trend line, right? Price bounced back from this level. Earlier also, it acted as a it played a very crucial role as a resistance, but after the breakout, it is acting as a support now. Now, at this point of time, this is a next swing high, right? This is a swing high. There's a resistance that acts as a resistance, and that will be our target. Now, if you observe carefully here, that is a very big bullish candle, right? Very, very big bullish candle at the support. So our entry will come above the high of that candle, and stop loss will be below the low of that particular candle, and this will be our target, right? So this is how one can take the trade. So now many people struggle a lot to plot these support or resistance trend line, friends. So for them, I'll suggest one indicator actually. So it is called as support resistance dynamic V2. from loan, something like that. So you can plot this indicator. I don't know the logic or rationale behind this particular indicator, but it sometimes, and most of the time it plots the resistance and support lines very accurately. You can see here it acted as a resistance here, it acted as a support here, it acted as a resistance, it acted as a support here, support here. So you can go to any stock. For example, I will go to Reliance. I'll go to Reliance. See here, it acted as a resistance, it acted as a resistance here, then it breakout happened, price moved up. There is a resistance here, there is a support, there is a support, there is a support, there is a support. You can go to any other time frame also. For example, I will go to hourly time frame. Still see, so they plot it plots the lines pretty accurately. So if you don't know how to draw these lines, means you can also make use of this indicator. And I always say one thing, friends, using or studying multiple strategies is not a good idea. Always pick the type of trading which suits your personality and your work style. Then go in depth, study that particular strategy in depth, because strategy is only one aspect. Next aspect is your risk management, how much risk you will take per trade. It should be always less than 2%. Okay, so don't take more than 2% of your capital risk per trade. So that is number 3. And always executes the trade, because when you do the back testing with the historical data properly, how much maximum you do, you get that much of conviction on that particular system. So you should try to do the back testing for with 5 years or 10 years of historical data. So once you get the complete confidence, then you can start taking the trades. And you should always maintain a trading journal and study your mistakes once in a while, once in a month or once in 2 months. Always study your mistakes, because your mistakes will give you a lot of clue. Then if you rectify those mistakes, if you fine tune those mistakes, or if you avoid those mistakes, you will be able to make profits even with swing trading. I hope this video is really helpful, friends. If yes, please like the video, subscribe to my channel, and we'll see you in the next video, friends. Thank you.